With record numbers of fixed rates expiring in 2023, many are going to get caught out with their repayments tripling and the so-called mortgage cliff coming up. Today, we're going to go through everything you need to know about refinancing. Tip number one, refinancing can help reduce repayments.
18 months ago, we were contacted by Jose. He and his wife were finally ready to buy a property. We went through his whole process, and unfortunately, he had quite a large unpaid default. We looked through our panel of lenders and didn't have anyone that could deal with a default of that size. Jose went off and ended up getting the loan directly through a third-tier bank. It gave Jose and his wife an opportunity to at least buy their home, get settled in. But fast forward 18 months later, he called me up in a bit of a panic. His interest rates had gone from 5% to 7.5% in only a few months. He was concerned that he wasn't going to be able to afford his home. We went through all the details and looked at his credit file, which had actually since been repaired, and he had managed to get the default removed. We were able to refinance his loan to a different lender, and we were able to save him 2% off his home loan.
One of the major benefits in refinancing is you get a lower interest rate and you lower repayments. This calculator can be really helpful. I'll include in the link below. You can enter your current loan balance, your current interest rate, the new interest rate that we can get. As you can see here, by switching banks, his repayments go from $4,654 per month to $3,605 per month. Saves $1,049 per month, and that $1,000 in switching costs will actually be recovered in 2 months because of the big difference in interest rate. The crazy thing, if he kept making his repayments as if the loan was 7.5%, even though he's only paying 5%, he's basically paying another $1,000 a month. He'll actually pay the loan 10 years faster. He's making the same repayments he was making with Liberty. Because interest rate's lower, you're paying an extra $1,000 a month and you're going to pay your loan off 10 years faster. Insane.
Another thing you want to watch out for when refinancing to a lower rate is that you're not resetting the loan term. In a lot of cases, mortgages are defaulted at a 30-year term. If you've had your loan for the last 5 years, the last thing you want to do is reset the term. Yes, you do have lower repayments, but you're going to be paying the loan off over a longer period of time, which means you pay more interest. When refinancing, aim to keep the same term that you currently have. The second reason you might look to refinance your loan is to release equity for your finance needs.
Last month, we settled a loan for Sarah and her partner. Sarah bought a property only 3 months before in Forest Lake, which is not far from Brisbane CBD. They used their existing bank, Suncorp, to buy the property, and at the time only had a 10% deposit, so they had to pay lender's mortgage insurance. When they contacted us, we had to look across our panel of lenders, and in only that 3-month period, their property had increased enough to refinance out with the equivalent of a 20% deposit. Different banks value properties differently,
which will help you have more equity.
Some banks will send a physical valuer out to the property to see what it's worth. Other banks will just rely on automated valuation models or computers just to say what they think the property's worth. And this can go one of two ways. It can make your property look like it's worth less than it actually is. They might be comparing your 3-bedroom brand new sparkling unit with 3-bedroom ones that are 100 years old and don't compare. In Sarah's case, they were comparing it to bigger, nicer homes, and as such, actually increase the value of her home enough to help her refinance out. Big benefit here is you're seen as a lower risk to the bank. With Suncorp, when she bought, she only had a 10% deposit. She looks like a riskier borrower, and sometimes they give you less favorable interest rates. Fortunately, when we helped them refinance, the bank viewed them as a solid gold borrower. They viewed them as someone that's got 20% equity, and as such, one of the lowest risks, and gave them better interest rates and a cashback.
The third reason to refinance might be to consolidate higher interest debt. Are your debts getting out of hand? There are things you can do to get out of a headache. You can refinance to consolidate your debts into one cheaper mortgage and one cheaper monthly repayment. One thing to be careful of is when you refinance and consolidate debt into one loan, you will be paying it off over a longer period of time. Potentially, you will get a lower rate, but by paying it off over a longer period of time, you'll actually pay more interest. And this is where you can split the loan into two, where you can have your debts consolidate for your credit cards, car loans into one loan, which is separate from your mortgage, and then focus on paying off that loan faster. By consolidating your debts, you can potentially save thousands of dollars. If you structure it right, you can pay down the debt faster than if you were to continue to try and manage multiple payments at once.
For example, if you've got an existing home loan of $500,000, typically a home loan has a 25 to 30-year loan term. You might be consolidating a credit card and a personal loan that have a 7-year loan term. If you consolidate everything, your existing repayments are going to go from $4,150 a month to $3,400. So you're actually saving $711 per month. But you're extending the term of the credit card and the personal loan to be over 25 years. You actually end up paying $19,000 more because of the extra interest payable. It's not because it's a lower interest rate because you're going from 25% and 10%. It's because you're paying it off over a 25-year term, and overall it saves you more. This is where it's beneficial, where you might have a separate loan split. So you might have one for $500,000 and one for $60,000, where the $60,000 loan split is paid off over 7 years instead of 25 years.
If you enjoy videos like this, be sure to hit that subscribe button to keep up to date with all things property and finance.
A common time we see debt consolidation is at the end of a construction or if there's been some major renovations. What can typically happen is you'll start your construction renovation, you'll go out with guns blazing, then along the way, you'll see a couch, a kitchen, some light fittings, and you pay on your credit cards. Before long, you've racked up a debt on your personal loan, credit cards, and also on your home loan. Not long ago, we were contacted by Brad and his partner. They just finished building their house with one of the major banks and they'd paid lender's mortgage insurance. In that 12-month period, their property value had gone up massively. And interestingly, this bank had a policy where if you sold or you refinanced within 12 months, they'd give you a partial refund on that lender's mortgage insurance. It was over $8,000, so it was totally worth looking at doing. As a part of the process, we looked at another bank. We set up the refinance. We looked at the home loan itself. We added the two loans together. We consolidated or added a $50,000 personal loan to the loan. This personal loan normally has a 7-year term. A home loan has a 30-year term. If you extend out that 7-year one, it can cost you tens of thousands of dollars. Fortunately, we were aware of this and we structured it in a way where the personal loan would be completely paid out in 7 years. So what was the end result? Their personal loan interest rate went down from 15% to 3%. Their home loan repayments were lower and they were in a better position over. If you are feeling uncomfortable and a bit of a pinch with your credit cards, personal loans, and different liabilities, then consolidating your debt can be a good idea if you have a broker that can help you set up in the right way. That's what we do here at Hunts Galloway. We help home buyers and home owners across Australia with paying off and getting out of their debt.
The fourth reason you might look to refinance is to remove a guarantor.
You might have bought your home using your parents or a guarantor a few years ago and not had to put any deposit in. The bank, in those cases, will lend you 100% of the property value. I had a recent one with Grace where she bought her property 5 years ago. It was $500,000 at the time and she had a loan of $500,000. Fast forward now, 5 years later, her property is now worth $800,000, which means she has $300,000 in equity available. We were able to get a new valuation done in her home, look at another bank. She was able to get a $4,000 cash back to refinance her home loan across and remove her parents as guarantors.
If your parents assisted you with a guarantee, there are solutions out there that you might be able to refinance them. I've had clients that would be able to do this within 12 months because the market raised so quickly. There was a 30% rise over the 12 months in 2021 where we were able to remove it. If you have a guarantor at the moment, hit us up and we might be able to get it removed. Reason number 5 to refinance is if you got a low doc loan or bad credit loan at the time where your circumstances were a struggle, and now you might be able to revisit your situation.
This is a common one we see where you might have bought your home where you're only just recently self-employed. You might not have had the 2 years history there. You might have just changed jobs and had to go to a lender that only catered with your bonus and income in that situation. And you might be in a better employment situation where you can change banks to help you pay it off quicker or to release equity to buy an investment property. And this is where we can help out. We've had customers that have started with Pepper, Liberty, Latrobe, all these non-bank lenders who are paying significantly higher interest rates. And by refinancing, we're able to get their repayments down and help them accelerate their property buying journey.
And it might not even be that you've gone with a non-conforming lender. It might have been that your borrowing power was limited at the time of your application and you had to go with one specific lender over another. In those situations, it's worth revisiting and seeing if there's any other lending options that are going to be better suited to your needs. Reason number 6 to refinance your loan is to get potential tax benefit. If you're looking to refinance to access equity in your home and you're using those funds for investment purposes or even buying shares or wealth building opportunities, you may be able to take advantage from a negative gearing or tax depreciation perspective.
It's definitely worth talking to your accountant on this. Another common thing we're seeing at the moment is people that might have had their investment property on principal and interest. They're changing things across for interest only. And it goes back to that cash flow situation where you might be saying, I'm going to use all my excess cash to put into my owner occupied, my non-deductible debt, and I'm going to limit or increase my cash flow on my investment property. And
if you have an interest only loan, you're literally only paying the interest, not the principal or the amount you originally borrowed back. In this example, we're looking at a $500,000 loan with a 5.5% interest rate, interest only. There's a $778 difference in the monthly repayments when you compare the interest only over the first 5 years to the principal and interest repayments. If you're saving almost $800 a month, it means you could put those funds to something else. But it does end up costing you substantially more over time. For the first 5 years, you're only making interest only repayments, and the $500,000 you originally borrowed stays the same. On year 6, you have to bounce back to principal and interest repayments. In this exact situation, you'll pay about $40,000 in extra interest costs. With any interest-only decision, we definitely recommend seeking the advice of a financial planner or an accountant. Another thing to consider is the difference between principal and interest-only repayments. On this simulator, you can see with this customer, their principal and interest rate might be 5%, interest-only might be 5.5%. If they were to do 5 years interest only, they potentially would pay an extra $35,000 by not paying down the loan or the principal for the first 5 years. And it would cost them another $12,500 In total, you'd pay $48,000 extra by doing interest only for 5 years in this set of circumstances.
Do you currently have a fixed rate and it's coming up soon? Well, get in touch with us at huntergalloway.com.au. We're the home for home buyers across Australia and help with refinancing Australia-wide. There's no cost for our service, and if you're looking for a great mortgage broker, we can help. Call us on 1300 088 065 or visit our website and fill out the contact form at huntergalloway.com.au. And guys, we'll see you next time.